Today, within what you call the schedule of investments that you can invest pension funds in, or the asset classes and the maximums that you can put, derivatives has been allowed as an asset class. You can actually invest up to 5% of the funds that you invest into the derivatives market. So that has been approved in the Retirement Benefits Authority's investment guidelines, regulations. So what we're trying to do now is working with the fund managers and the trustees to help amend the investment policy statements to allow for derivatives. So we've been having a conversation with them so that they can start effecting those and allowing the fund managers then to invest in derivatives. So there's a lot of development taking place in that and progress towards allowing that. And it's essentially because of this risk management opportunity that would help the funds in terms of protecting the risks on that.
Is a 5% limit enough to address the liquidity or the risk of the entire portfolio? Is this just a small testing window that eventually will be opened up so that they can be able to hedge a bigger portfolio much more efficiently?
Being a relatively new instrument, we believe that it's a start. We are opening it up so that fund managers and trustees can appreciate the values of being of the derivatives and don't feel overly exposed. But we believe that as this market grows and develops, that limit will progressively be revised. The other thing that I see coming encouraging and RBI thinking of in the future is to allow investment policy statements to be really set up by trustees themselves, depending on their risk appetite of their funds, and I think they will then give flexibility for them to accommodate additional holdings. So I think those are the things we're saying. I think it's a start, and a lot will depend on how the markets then open up and the opportunities and how the market behaves. So that we can see this grow.
I mean, let's switch to retail investors. To what extent can retail investors participate in this derivatives market?
This is a very important segment for us. In fact, our whole education campaign will be very strong on how to bring in the retail investors. And why do we need them there? I think they give us the desirable volatility that needs to trade, because most of them will come and want to buy and sell, and we need that level of activity happening. So we also believe that there will be a lot of retail investors interested. Right now we have, I said, over 25 contracts that have been bought that are currently open in the market. We're seeing a lot of high net worths interested. I think those will be the first ones to come in. There will then be a lot of retail to come in, but we want to have a lot of education because we want to make sure they understand that this asset that you're getting into has opportunity to make you a lot of money, but also opportunity to lose money. And you really have to appreciate both sides. So education is going to be our biggest issue around the retail to make them clearly understand these products. But I can tell you, based on what we've seen internationally, the retail participation is very high in this kind of products. One, because of the access, the volatility, the ability to really buy and sell frequently, the money moving in and out. That's what excites them. And we see that as a future.
They have trading tendencies.
So
that's exciting. What about banks? How are banks going to benefit from this market?
So banks will benefit in that one, the monies that are coming through their systems. They are retaining some of it as part of variation margin, and as they retain that money, that gives them liquidity. I can tell you, I thought in the opening statement I said last year the total value of trades was 544 trillion. 544 trillion.
$544 trillion.
Globally.
In derivatives.
In derivatives. All right, and that was over 6 times the global GDP.
Wow.
You're talking about money. Once this money starts coming in, the liquidity for banks will improve naturally. So they've got a flow of funds coming from various places that they can, and they'll be retaining a portion of this to help with liquidity. Over and above the fact that they'll be making fees on every trade that happens.
Wow.
So it then helps them with their non-funded income streams. The fact that now and also a new customer base. And these clients coming in gives you the opportunity to cross-sell other products. So a brilliant bank will look at the wider benefits even beyond just the ability to provide an access for them to trade, to look for how they can cross-sell other products. Because I believe when a client signs up, they then believe and want to see what else the bank has to offer. And I think those are the opportunities to offer. But over and above that, the liquidity coming through the system would be a very good benefit to banks.
So liquidity and a new revenue line.
A new revenue stream.
That's good for banks. They've been looking for something to ramp up their ROEs.
Yes, certainly, yes.
What about your regular investment banks and brokerage community?
Investment market brokerage community, I see them making money through trading fees, which now expands their current streams. Right now, you can see the market is not as active as it should be, so the revenues are down. But now you have a new market that can, with time, can match what you're currently earning. Over and above that, there's market making opportunities. One of the key players in this derivatives market is to have a bank or a player that can buy and sell. Anytime an investor wants to get in or get out, and that comes with fees. So those players, so now they'll be able to become what they call market makers, to make markets, and that's going to be a very good opportunity for them as well.
Okay.
So I as you can see, there are benefits for everybody in this whole ecosystem.
And just one last point. One of the things that troubles investors who are focused on investing in Africa is currency movement.
Right.
Do we have something that is readily available to hedge on the currency and to be economically viable for an investor? Or is it something that will be coming down the line?
That will be coming down the line. We deliberately decided to start with equity futures because we want people to really clearly understand how derivatives markets work. So we're going to be offering these features for a bit of a time, for the beginning. But there is conversation to look at the currency in the near short to medium term. Because we want to be very sure that the markets will understand these products before we start exposing them to what we call a bit more sensitive assets like currencies. So that's a conversation we're having.
Oh, thank you so much, Jeff.
All right.
As you've heard, this market is holding goodies for everybody that participates in the capital markets, from banks to foreign investors, local investors, stockbrokers, and the entire investment community at large. So stay tuned in, and this is an important market for you. It's a game changer, as Jeff said in one of the previous episodes. Thank you very much. This is Pius Mushiru Mugo, the Managing Director of Nammo Capital, and you're watching Invest in Africa.